Okay. So thank you all for joining. This is Sunday morning, so appreciate all of you for taking out the time to listen to this. So while I get started, just let me quickly give you a very brief intro about myself, and then go through the disclaimers, and then let's get started. So my name is Abhishek Basumallick. Sort of been investing for the last 24 years. So 2000, just before the dot-com crash, I started investing, and it's 24 years of going through the ups and downs of the markets. Uh, my by education, I'm an engineer. I've done over the last period. I've done two MBAs, one executive MBA and the other of full, a normal MBA finance. I've spent about 19 years in IT consulting in one of the global MNCs before calling it quits and moving on to becoming a full-time investor, uh, running Intelsense, and now also uh, our PMS and Sri Rama managers. My basic interest is I like learning about different business models, different investment strategies. So I'm one of those people who are strategy agnostic. By that, what I mean is I do all sorts of things. I do fundamental value investing. I do growth investing. I do momentum. I do technicals. I do quant. So all of it. My perspective is that all of this is information, and when we are trying to uh, you know uh, build our wealth, all sorts of information is welcome. I'm also very keen on understanding about people behind businesses, so that is something that sort of uh, helps me understand what kind of business will do well, what is the longevity of the business, because ultimately it is the people who are running the businesses that uh, that matter. Typically, I have very long-term horizon. By that, what I mean is I look at time horizon from a portfolio perspective. So when I say that I have a long-term horizon, I mean that I intend to invest for the next 20, 30 years. But that doesn't mean that the stock or stocks I hold will be there. The same stocks will be there for 20, 30 years. It means that the investment process will continue. The stocks may change over the period. uh, Value Picker Forum, some or number of you may be aware of it. So we've been uh, so you know we started Value Picker Forum about in 2010. I've been one of the founding, the starting members, been a moderator there during the entire duration. Love to read, play, and watch sports. So that's overall about myself. Uh, Basic disclaimer: any stock that we discuss, we'll probably not be discussing individual stocks, but anything that we discuss, please take it with a pinch of salt. Whatever we are discussing today is more for our education, to enhance our understanding of markets and businesses and strategies. And with that, let me start off today's presentation. So uh, when I was thinking about what to talk about today, I thought, I will talk about the biggest challenge that an investor faces, right? And typically it is challenges related to our own psychology, our own behavior. And the last few months, that has come a lot more to the forefront because markets have been extremely volatile. Markets have been going up and down very sharply. And all around us in the financial media, people are talking about small caps and mid caps getting overheated, or some event will happen, wars starting, there is oil embargo, there's some missile hitting somewhere in the Middle East. So all of these kinds of negative news flows continuously come. US rates, some commentary from the US Fed about rate rising, going down, etc., which is impacting the markets here. And stock prices going up and down very sharply. And what happens when prices start moving very sharply is investors become very, very, uh, you know, reactive and get puzzled in what to do. So I thought, let me talk about, having some kind of a mental framework in terms of how to address these kinds of, these kinds of times and these kinds of challenges. And then we'll look at, uh, maybe a few examples on using these strategies over a longer period of time. So what typically happens, we see is that when there is a market crash, even if it is for a day or 2 days, people start panicking. All of us, we think that, and especially when the fall is very sharp, you will notice that everybody starts to think that, okay, is this the beginning of the end? And people are very trigger happy. They sell in panic. And exactly the converse happens when the portfolio is going up, when stocks are going up upper circuit every day, especially in the high beta names. It feels really great. You feel in the top of the world, you feel that, you know, nobody can beat me. I've, sort of aced this game. And the third, thing that happens, and is very prevalent nowadays, and this is not only for retail investors, but this is even for institutions that we see, is that the fear of missing out. So, I have not bought. For example, if I'm sitting on cash, looking at valuations, and my friends have bought and they're making a ton of money, or no, let's say I have not bought a particular sector. So let's assume that I've not bought PSU banks and they have done well, or defense or railways, and we see, huge amount of money being made on those stocks, and our friends bragging. Then this fear of missing out makes us, jump in, maybe at sometimes at the fag end of a rally. And then even inevitably what happens is the typical retail investor phenomenon, which is we buy too late and we sell too early, right? Digesting bigger returns is also become is a problem with investors. So if we buy a stock at 100 and that stock goes to 120, 130, 150, we are itching to book profits. Sometimes if it goes up very quickly, you tend to book profits, even though the stock might be headed much, much higher. The other exactly converse is also sometimes true, and this is true more with people who are value investors, where they end up buying too early, waiting for a long period of time, when the stock does nothing. And when it starts moving up, you think that, okay, I've waited patiently for so long. Now the stock is moving up. Let me book profits and, take my money off the table. So in both cases, it's we are making suboptimal decisions. Uh, the other, market conundrum that I see people is when the market is going up a lot, people are, not people are hesitant to invest, thinking that, बाजार इतना ऊपर चढ़ गया है और कितना जाएगा, थोड़ा वेट करते हैं. And conversely, when markets are falling, uh, people think that, markets have fallen a lot, let me jump in, right? And typically I have seen this behavior in stocks where there is over ownership. So over the years, stocks I've seen, like, JP Associates or Yes Bank is a very typical example. Suzlon in its days, uh, Paytm now, a lot of people, Reliance Power in at one time. So a lot of people, bought after the first selling wave had come, and they thought that, ये 100 का 50 हो गया, let me buy now. Uh, and even, what eventually happened was वो 50 का 10 हो गया. So we need to be able to have some kind of behavioral pattern in our mind, uh, which is there. And so this is a quote that I keep in my office all the time. And this is a great quote which tells us that market is not only about numbers, it is not about valuations only, it is also about psychology. And the bigger, in fact, the bigger part is psychology, because psychology tends to overwhelm the behavior of participants. uh, People tend to behave differently when stocks are going up, they tend to behave differently when stocks are crashing. So inevitably the amount of wealth that you create over the market, in the market, over the next years or decades, is more going to be determined by your behavior uh, at different points in time in the market, rather than the stock picks in general. uh, you know with a little bit of help, people can pick good stocks, right? But uh, the problem arises in other challenges with allocation, challenges with uh, whether to buy average up or down. So those are bigger challenges that I've seen people grapple with. So the way out, what is the way out of all this? Now the thing is, if you think about any other profession, right? Wherever there is a lot of uh, decision making required, what happens is people use checklists, or people use some form of quantitative analysis. They have rules in place which will tell them what to do, or how to behave in a certain situation. So what I sort of talk about is something called as quantamental approach, which is a quant based fundamental approach to investing, which helps in avoiding basic biases and misjudgments and errors in behavioral psychology. So uh, Daniel Kahneman, who has won the Nobel Prize for his prospect theory, uh, in his research, he's found that uh, the simplest of algorithms actually perform better than uh, the intuition of geniuses over a longer period of time and over multiple sample cases. So if I use that, if I'm able to build uh, simple rules for myself, whether I am doing fundamental investing, whether I'm doing technical analysis and technical chart based trading, if I am able to make simple rules for myself and then stick to those rules over a period of time, what you will realize is that your results in while you are investing gets much better. And uh, whenever we talk about investing with rules, uh, the rules could be very simple, right? It does not need to be extremely complex, extremely mathematically oriented. And sometimes even when you are starting off, it need not be quant based also. It can be a very simple uh, you know uh, statement of intent that you have when you are actually doing your investing. So I thought, let me take you through a simple example of a strategy which is more fundamental based, and where we are talking a little bit about how we look at the different aspects of investing. So what happens is, when you are looking at investing, there are four distinct steps. So first is, you need to select your universe of stocks. Second is, you need to be able to pick the stock or the stocks that you want to invest in. The third is you need to determine the allocation, how much you will allocate in your portfolio. And third is you need to determine how long to hold or when to sell. These are the only four steps, or these are the four steps that is there in any kind of investment or trading, right? And you can have simple rules. So I'll just, for example, when the first step is universe selection. So somebody, when say Warren Buffett talks about having a moat, having a, uh, you know, uh, uh, having a circle of competence, he's just basically talking about this step of having a universe that you want to play in. So for some people, the universe could be, I will only want to buy stocks that are within Nifty 50. Some people want to only buy stocks which are in, say, the financial sectors because they understand that sector well. Some people may want to say that, okay, I will only buy, micro caps and small caps. So you have to first define your universe. The next step is you have to define how you will pick stocks. So have some form of a checklist for yourself. The checklist could be, again, mathematical, or it could be a simple qualitative checklist, but you need to have some form where you can decide. I personally prefer having a quantamental, so a quant plus fundamental checklist, where I can, it becomes easy for me to pick out stocks and then study them based on their fundamental merits. So here is one example. So for example, so this one, I'm looking for stocks where the return on capital employed is improving year on year, and the base is, it is better than 20%. The PE is less than 20, and debt to equity is less than 0.5. And the profit is growing at more than 10%. Market cap is greater than 500 crores. So the reason, I've mentioned the reasons here. It's very simple, right? It's not a very complicated screen. You just look for these. Then the next thing is, how many stocks do you want in the portfolio? So with this screener, let's say you will get 352 stocks, for example, just a random number. But you cannot, or you don't want to buy 350 stocks. You want to buy, say, 10, 15, 20, 25. So assuming that we want a 5% allocation, we will end up, putting 20 stocks in that portfolio. And the exit criteria, how long do we hold, is, let's assume that we have a rebalance period of, because quarterly results come in, so we'll have a reset period of quarter, right? So if that is the constraint, what we see is, again, why we've picked 20 is that if you see here, roughly around that 15 to 20 stock mark, benefits of diversification starts going down drastically, right? So there's no point in actually diversifying more than 15 to 20 stocks in a portfolio. So I have seen a lot of people having 50, 70. You look at mutual funds, they have 70, 80, 100 stocks in the portfolio because of their size. But it actually does nothing for improving diversification. The benefits you start accruing, by the time you get to around 15 stocks. So let's assume that these are the portfolio construction. And then I ran it with 3 additional constraints of, technical based, sorting criteria. And here what happens is, let's assume that those 350 stocks I get, I will pick the top 20 based on the highest net profit growth. In this case, what you will see is that the strategy is producing a 17.4% CAGR. Okay. And this is over a very long period. This is over a 15-year period of testing between 2008 to last year's March 23. Okay. Now, the same algorithm of sorting stocks, if I use ADX, which sort of gives a momentum or strength of trend kind of indicator, with the same fundamental sorting criteria, if I sort it with ADX, the CAGR improves by roughly 5%. It goes to 22.9%. And Thirdly, if I test it with RSI, you see that it has gone to 21.8%. And mind you, roughly the CAGR for, let's say, a Nifty or any benchmark is significantly lesser than that. So if you see the last, two lines, with net profit, the absolute return is 938%, whereas the benchmark is 279. Similarly, with ADX, it goes to, 2000%. So roughly it is, gone up 20x over this 15-year period. And similarly for RSI. So what I, with this example, just what I wanted to share with you is that it's very simple to create simple rules, back tested over a period and get reasonably better returns, which will over a long period of time outperform the benchmark indices. Now here you will also see the maximum drawdown, which is 60%, 52%, and 54%. Now in a real life situation, if you are investing, my experience is that a 20% drawdown at a portfolio level is when people start really getting scared, and that is when they start panicking. So it's always better to uh, try and reduce this drawdown. So is this kind of a strategy something that I will be comfortable investing large sums of money in? No, because I will need to tweak it so that the maximum drawdown is limited to, at a portfolio level to maybe 15-20%. What that typically does is it will also reduce the returns. The moment you start cutting drawdowns, your returns also tend to reduce over a period of time, right? So just a simple example of how simple strategies, rule-based strategies can give you significantly good returns over very long periods of time. And here, if you see, we are just, holding 20 stocks, so not overly, diversified. We're not playing around with hundreds of stocks, and we are only transacting once a quarter. So with some of these thoughts in mind, we've created at Intelsense multiple, small cases. So I'll talk briefly about these three. Quiver is a multi-factor strategy. Quantamental, Q10 and Q30 are two momentum-based strategy. Q10 is an absolute momentum strategy. Q30 is a relative momentum strategy. We've been running both for over 3 years with reasonable success, as you can see here directly. So Quiver, basically what we do is we look at 10 stocks, again, completely market cap agnostic, and we are looking for, this is the reason it is a multi-factor, is here we look at growth, we look at momentum, we look at value, we look at mean reversion, and we have stocks across all of these in the 10 stocks that we typically have in the portfolio. So over a long periods of time, this mostly tends to perform reasonably well. And that you can see in the chart over the last 3 years that we've been live. Q10 and Q30 are two momentum-based strategies that we have. Q10 is based on absolute momentum, and Q30 is based on relative momentum. We started initially when we launched these two strategies. Q10 had roughly 10 stocks. Q30 had 30 stocks, and that is how the name came about. But we keep on, doing research and doing backtesting, tweaking these strategies. And what we've realized is that, somewhere for these strategies between, 15 to 22, 23 stocks is what the sweet spot is. So that is what the current strategy tends to hold. And the benefit of a momentum strategy is when the market is uptrending, they tend to do really well. When the market is not doing so well, a momentum strategy is not going to perform well. It's going to sort of, slowly bleed to death with small cuts. So that is the nature of the strategy or the factor that we are playing with, right? So that is what I quickly wanted to share with you. All these small cases you can take a look at from intelsense.smallcase.com in case you are interested. And with that, let me then go back to our Zoom and let's take questions. So you can put up your questions and let's start. Okay, so first question is from Sharad. I'm looking to add some lump sum amount, but considering the market condition, should I do that or wait for a correction? It's a very interesting question, and perhaps this is the most common question asked in every forum that I speak to or everyone that I speak to. So let's understand this again from a market psychology perspective. Uh, Anyone who tells you that they know what will happen tomorrow is just sort of talking through his hat. No one knows what is going to happen tomorrow. No one knows whether Nifty is going from 22,000 to 25,000 or it is going back to 19,000. No one has a clue, right? There could be any surprise event which could take the market higher, or it could take it lower. So without foresight, right, without knowing what is going to happen in the future, how do we plan to invest? So the first consideration that we have to think about is, how long am I investing for? What is my time horizon? Do I need this money in the next 6 months, 1 year, 5 years, 10 years, 20 years, 30 years? If my time horizon is reasonably long, right, 2 years, 3 years plus, then you can invest at any time in the markets, right? Uh, the point here is, it is more important to get invested, because what happens is, today let's say Nifty is at 22,000 and you decide that, okay, it is at an all-time high, I will not invest now, let me wait for it to correct, and assume that that correction does not come. The correction comes when Nifty goes to 25,000 and you get a 10% correction. So Nifty falls by 2,500 points. Still, you are above this 22,000 that you are today, right? And I have seen over the years many people, especially this happens more with value investors, because they get trapped in that valuation model that they have in their head, uh, and say that I will not participate till I get my valuation. Now, if you have that kind of patience, and that you can sit out for 4 years, 5 years, 10 years, then you can do it. But what typically happens in this situation is, at some point in time, FOMO will capture you and you will jump in, probably when at the last moment or the second last moment, and that will sort of become an exuberant kind of situation when you are putting in your money, and then the market starts falling right after that. And this is a very common scenario. So I always suggest people to, instead of putting in a large lump sum, again, large lump sum needs to be defined as a percentage of your existing portfolio. So if you have a portfolio of 100 rupees and you want to add, say, 5 rupees, to me, that is an incremental addition. But if you have a portfolio of 100 and you want to add, say, 20, 25 rupees, that's a meaningful addition. So if you are incrementally adding in a SIP mode, or in a weekly manner or a fortnightly manner, I think that is a very sensible way to go about investing, especially in a market condition like now, which is that where when we are in a bull market. The next question is, I have a few mutual funds. This question is from Amit. Individual stocks and small cases and as well. How do I know if I'm diversifying my portfolio enough? Very good question. So this will need a little bit of hard work. You will have to download your all the mutual fund portfolios, put it in a Excel sheet, do the same thing with your small cases, in all the small cases that you have. put all the stocks that you have in the portfolio in an Excel sheet along with their the current values, and then just calculate the allocation at the overall portfolio level. First of all, you will see that especially in mutual funds, there's a lot of overlap. So that's something that is the first thing that you will notice. And as long as don't have a very large number of stocks, to me, I think in 30 is like the upper limit, but most of the time, if you're investing in mutual funds, it will be much more than that. But another aspect is trying to see how many stocks you have where the allocation is less than, say, 1 or 2%. Because most of the time, what happens is whenever you're investing in mutual funds, etc., what happens is you have a lot of stocks where allocation is 0.1%, 0.2%. Now, even if a stock doubles or triples with a 0.3% allocation, it's not going to make any meaningful difference to your portfolio, right? So that's something that you need to think about. But having said all of this, if you are investing primarily in mutual funds, there's not too much you can do about it, right? In terms of diversification, just one commonsensical thing to do is maybe diversify across market caps, or have a multi-cap funds. So you could have, say, a large cap or a mid cap, small cap kind of segregated funds. Beyond that, I don't think you will have too much of a leeway in terms of how you can diversify. The next question is from Raghu. Markets are at an all-time high right now. I want to book profits, but this is an election year. I feel the market could go up or be choppy. Should I buy, hold, or sell my investments during this period? Again, very similar to the first question. Nobody knows what is going to happen in the future. So, so the way to think about it is, unless you need the money right now, think about whether it really makes sense to book profits. The other is, if you are a very savvy trader, investor yourself, you might want to book some profits and stay in cash just in case the market falls. But again, those are complicated decisions. It's very difficult to be able to do it perfectly and do it perfectly consistently. Both those things are important. You need to be able to do it well, and you need to be able to do it consistently. The challenge is, once you book profits, right? Let's say you decide, I'll take 30% off the table. You book 30% and you are holding cash. When the market falls, most of the time what I've seen is you will be very reluctant to get back in. You will wait for the markets to stabilize. By the time market stabilizes and it starts shooting up, and most of the time what happens is you'll not be able to get in into the market. And by the time you get in, you're already like you've sort of completely missed the fall and the recovery. So my take would be, unless you are very savvy in terms of timing the market, it is better to stay invested if you have a reasonably long term. Election year, etc., hardly makes any difference if you see over the last, say, 5 election years, or last 30 years. It is no different from any other year. Every year we see 5 to 10% correction from the top. Very difficult to be able to time it. And so short answer to your question is, it's a very, very difficult problem to solve. And the other point I want to sort of emphasize is this obsession with or not obsession, or this fear with all-time highs, right? So I keep hearing this a lot, that market all-time high hai, what should I do? The problem or the reality is that say Nifty, from its journey of 1,000 to 22,000, and subsequently, let's say Nifty will, at some point in time or someday, it will get to 50,000 also, right? Let's say in the next 7, 8, 10 years, from 22,000, Nifty will be 50,000, right? Now, Now, at every point, 22,000 to 50,000 journey, it will continuously have to go through all-time highs. So how how long will you be afraid and keep selling? At 23,000 also it will be at all-time high. At 25,000 it will be at all-time high. 28,000 it will be at all-time high. 30,000 it will be at all-time high. So at every increment it will be at an all-time high. That is the nature of compounding, right? What is your okay? So the next question, I think it also from Raghu is, what is your opinion on PSU stocks? I don't have an opinion usually on a certain promoter-based stock. So PSU stocks is where you have certain promoter, which is the government of India. Uh, I cannot basket everything that uh, the government of India owns into one basket, right? So in PSU stocks, like in any other set of stocks, you will have good companies, you will have bad companies, right? Companies which are profitable. So HMT, ITI are government of India stocks, PSU stocks, and the well-managed ones like say BEL or a HAL or a Rights or those other PSU good or an SBI. These are also PSU stocks. So there is a heaven and hell difference between the quality of the business uh, in these stocks. So you cannot take a basket call saying that PSU सारे अच्छे हैं या सारे खराब है. You have to go by case basis and then take your pick. What we have seen is definitely over the last few years, the governance, the corporate governance, the uh, profitability, etc., for PSU banks, so for PSU stocks have definitely gone up. So with that limited, kind of overarching theme, I think it's not something that should be, you know, bought blindly or sold blindly, right? Markets will always create themes. Our job is to look beyond the most prevalent, most popular narratives that are getting created, and just take one or two more steps more than that to analyze individual stocks, individual businesses based on the strategies that we are trying to, uh, strategies that we're trying to use. Okay. The next question is from Rahul. What is the right way to keep adding money to a particular investment? Personally, I am a very, very strong proponent of an SIP mode of investment. SIP not in mutual funds, but SIP in your own portfolio of stocks, whether it is through a small case, whether it is doing it directly. If you have a basket of stocks that you have, every month uh, or whenever you get some money, you can continuously add. Now, there might be a question that, okay, let's say I have 15 stocks in my portfolio and I do not have money to invest in all of them. So how do I go about doing that? So there are two very easy, again, these are the rules that I was talking about. So create these simple rules for yourself. Like, okay, if I don't have the money to invest in all the stocks that I have in the portfolio, I will take, say, the top 5 this month, the next 5 the next month, the third 5 in the third month, and then repeat it mechanically every month. As long as you are doing things mechanical, or you can say that every month I will buy the stocks that have gone up the least in the previous month. Or you can say every month I'll buy the stocks that have gone up the most in the previous month. Or you can say every month I will uh, buy into the stocks where I have the lowest allocation, so that I have a more balanced portfolio. So whichever you decide, and these are all legitimate ways of adding to your portfolio. So two points I to answer your question. One is, do it on a regular interval, whether it is monthly, weekly, fortnightly, quarterly, whatever, and then create a simple rule for yourself and follow that mechanically. Don't try to overthink it and over engineer. Next question is from Saroj. I'm subscribed to your Quant Q30 small case. Really happy with the performance. Should I subscribe to your other strategies? How are they different? So Saroj, thanks for the comment. Uh, so just as I explained, we have three different strategies. Q30 is relative momentum. Q10 is absolute momentum. The difference is basically in Q10 we are looking at individual stocks in the basket, which individually are in momentum. In Q30 we are looking at stocks where they are momentum relative to other stocks in that same industry. So that's the difference. Uh, Both have between 15 to 30, roughly 15 to 20, 25 stocks each. Quiver, as I mentioned, we have 10 stocks, completely market cap agnostic. It is also multi-factor. So to an extent, you get the best of all the worlds. You get momentum, you get mean reversion, you get growth, all of that punched into one. And to an extent you get the benefit of concentration, because you have only 10 stocks. When something does well, you get a reasonably large benefit out of that. So that's those the strategies. What I always tell investors is you need to pick strategies that you can stick with, that gel with your mindset, your psychology. Some people like a lot of churn. Some people want less number of stocks in the portfolio. Some people want to hold for a long period. Some people want quick turnarounds. So depending on what you like, or what you are comfortable with, you need to pick strategies based on that. What I personally do is I know that I am reasonably good in picking long-term growth stories, which sort of are multi-baggers or compounders over periods of time. So I use my quant strategies to fill in a more shorter term need for myself. So I am happy with the long-term stuff that I do myself, uh, more on the fundamental side. But on the quant side, I look for strategies which will give me returns over, say, a month or a quarter or a half a year. So that is the typical holding period that we have in all our shorter term strategies. So in simple terms, you have to pick strategies based on what you like, or what you can live with in the long term. Uh, Next question is from Bhupesh. How do you select a sector that performs better than others? There are multiple ways of doing that. You can look at relative performance of sectors. This is mostly a trend following method. So you will get to know once a sector starts doing better. Else, if you are doing a little bit more of fundamental, so more of quantamental, if I may put it that way, you look at technical parameters for different stocks in a sector and the fundamental factors in a sector, and you can see that some sectors are at times bottoming out, and turning around. You will get that information more from the fundamental side. uh, you can get, uh, if when you see stocks from a particular sector, all or most of the stocks doing well, starting to pick up, starting to so whenever I see a large number of companies from a particular sector or industry coming up in my quant portfolios, I know that that industry is doing well. So those are ways of picking out sectors that will that are doing well. Now, which will do well in the future is something that is inherently probabilistic in nature, right? Nobody knows which stock, which industry or which stock will do well in the future. You are trying to, everybody, whether you're doing fundamental analysis or doing technical analysis, you are actually looking at past data, past patterns, past trends, and you're trying to project what might happen in the future. Uh, so there is some amount of probability involved in looking at or trying to figure out which sector is going to do well in the future. The next question is from Santosh. Is Q10 based on 52-week highs or some other criteria? Just some broad idea on how companies are picked, how are transition points captured in Q10, Q30. So basically, no, it is not based only on Q52-week highs or such criteria. I mean, those would be pretty, I would say, pretty simplistic kind of momentum screens. I'm not saying that they cannot or do not work. They definitely do. But a lot of times, what we see is by the time a stock gets to 52-week highs, it is already gone up a lot and already in momentum. So uh, I cannot divulge the exact strategy that we use in any one of whether Q10, Q30. But the idea here is to pick out stocks which are in momentum, irrespective of whether they are in at the 52-week high or all-time high or whatever. Transition points in our quant strategies, we do not look at, uh, typically, we do not look at macro qualitative factors. So we do not look at what is happening in Russia, Ukraine, oil, uh, gas, politics, etc. We let mostly fundamental results and price action drive the decision making. So if there is a war going on and if the prices of stocks are not reacting to it, um, it doesn't really bother us, right? So that is how we look at when we look at more from a quant-based perspective. The next question is from Nafas. Do you think power and renewable energy sectors have a long way to go, or smart money can move to some other factors after taking profits? Uh, Again, power and renewable energy both are sectors which will play out over a very long period of time. If you've been following the news on climate change and COP, the plans that India and globally we have of reducing carbon emissions and greenhouse gas emissions, it and moving from fossil fuels to renewables. Obviously, this is a very long gestation transformation. So it will take 30, 40, 50 years. India's plan of going completely green, if I remember correctly, is on 2070, right? So that is about 45, 46 years from now. India is planning to become completely green. Now, what that means is there is definitely going to be an opportunity over the next 40, 45 years. Now, the question is never about the overall large opportunity size. If you see in India, uh, we've always been power deficient. We've always been infrastructure deficient. Does it mean that, the last 20, 30 years, the power stocks or the infra stocks have done extremely well? No, right? So these are purely, very cyclical companies, cyclical businesses. They tend to do well in short spans of time, and then they do poorly over, again, an extended period. So you need to be able to understand the cycle and to be able to time it correctly to get good benefits out of this. So power and renewable energy sectors as businesses will do well. In the stock market, they will continue to remain cyclical and continue to create and destroy a lot of wealth if you get the timing right or wrong, as the case may be. Okay. The next question is from Irfan. What are the sectors to concentrate in 2024? I think in the last 6 months, what we've seen is that we've seen a large amount of sector rotation. We've seen PSUs doing well. We've seen railways doing well. We've seen defense doing well. We've seen infra doing well. Cap goods doing well. And also we've seen uh, decent pauses in all of these. So PSU stocks were doing extremely well in the last couple of months. I don't think a lot of them have moved. Same for railways. Something else is doing now. I think it's more of these solar and wind and renewables which have done well. So uh, these are uh, these are questions that I mean, these are factors which will always be there. So some of the sectors fundamentally that I like for 2024 would definitely be manufacturing. I think in manufacturing we will be doing very well over the next 3 to 5 years. We need to be able to pick stocks correctly in that. Pharma, I think, is going to do really well. Real estate is going to really do well, hopefully. Auto and auto ancillaries is another sector that we need to look out for. I already mentioned real estate, and so real estate along with real estate ancillaries. So things like building materials also should do well. So essentially, these sectors are something which could actually do well, and of course, uh, a sector which I personally beginning to like, which is not done well over the last 3 4 years, is more a mean reversion kind of play. Is the insurance sector. A lot of looks like a lot of the pain has already been priced in. So these sectors could actually do well over the next 1.5 years. Okay, the next question is from Harendra. Some stocks in your small case are 80 to 100 PE. Are they overvalued? Good question. So I typically tend to avoid looking at P's when you are looking at uh, momentum stocks, because in momentum you're not looking at valuations, you are looking at uh, shorter term price performance. And I have seen stocks in momentum go up to 100, 200, 300, 400 P also. So P is, in fact, very rarely do I ascribe. In fact, I'm not a very strong proponent of looking overtly at P as a valuation metric. I personally think that valuation is more art than a science, and just looking at a DCF or a PE without understanding the context of the business or the growth prospects, etc., is very misleading. And most of the time, you will end up, or I have ended up, losing a lot of money or leaving a lot of money on the table whenever I've made decisions based on PE. So that's what I have to, this over the years, what I've seen. I mean, I've had examples of, say, an Astral, which I sold, I think, in 2014 odd period, when it was at 100 p, and the stock has gone up maybe 5 6 times from then, or maybe more. I don't remember. Uh, and the stock is still at 100 odd p. So doesn't, as long as the business performance continues to do well, I don't give a lot of credence to P's. Of course, the starting P, everybody would like to buy a great company at a 5 P, but that only happens when you are in a bear market. In a bull market, you will have to, especially when you are looking at momentum kind of strategies, you should be comfortable paying up with the knowledge that you have a risk management in place that will take you out if the stock starts correcting. The next question is Munna Singh. How many paid small cases should be there in my portfolio? And what should be an ideal mix of multi-cap, small cap, mid-cap, size small cases into it? It is completely up to you. There is no, hard and fast rule that you should have 1, 2, 10, 20. It's based on, what you are comfortable with. Uh, Personally, for me, I would not be very comfortable holding a lot of stocks, because then it ends up becoming very confusing. One, and two, the benefits of of some stock doing well is lost. So if I have, say, five small cases, each having 20 or 25 stocks, I'm ending up having 100 and 100 to 150 stocks. It means that per stock allocation is 1% or less than that. And to me, intuitively, that doesn't make any sense. So I would always err on the side of having between 15 to 20 stocks. uh, but if you're doing it only through small cases, or earlier, like I said, if you're only doing it through mutual funds, then you might be comfortable having two, three, four of them at most. There's no ideal mix of multi-cap, small cap, mid cap. It again depends on your individual risk appetite, your individual return aspirations, your uh, how do you how comfortable you are in sitting through drawdowns. uh, so someone can be, happy having 100% multi-cap. Uh, but whenever in doubt, this is again a thumb rule or one of those simple rules that I was talking about. It's always best to start with a equal mix. So if you are having a doubt in your mind about multi-cap, mid-cap, and small cap, just let's say uh, have 33% of each, one third in small cap, one third in mid cap, one third in large cap, right? And then keep topping up based on whichever is doing better, or uh, that way. Okay. Next question is from Anit. Sir, I've been subscribed to Quiver for more than a year and have seen 74% growth in my portfolio. Your thoughts on its continued marvelous performance? So thank you, Anit. Thanks for your kind words. See, I mean, performance is not absolute in terms of it's never absolute, right? Markets have been good. We've been lucky to an extent in picking up good stocks which have done well. The strategy that we follow uh, helps us pick good stocks over a period of time. So in Quiver, what we do is we try to pick stocks which has a potential of outperforming in the near term. Our time horizon is between 1 month to 6 months. And the other thing that we do is we tend to get out very quickly. So cutting our losses very quickly and letting our winners run. So we've had cases in Quiver where individual stocks we've held for more than a year, and that has gone up like 4 or 5 times. Uh, so if you just do the math, so you've had 10% allocation in a stock which has gone up, say 5 times, means you're already up. Your portfolio is up 40-50% just because of that one stock, right? So those are things that has helped us in performance, and hopefully, touch wood, I would hope that it continues that way. Okay, with that, I think we've sort of come to the end of the hour, and I don't see any more questions. So thank you all for joining and spending this 1 hour with me. And feel free to send me any of your questions or comments. And you know, if you're interested, do take a look at the small cases that we have at Intelsense. That's INTELSENSE.smallcase.com. Thank you.